September 15, 2008, Lehman Brothers Holdings files for Chapter 11. Bankruptcy. It's the largest bankruptcy in American history. $600 billion in assets gone, 25,000 employees out of work overnight, and the global financial system is about to experience the worst crisis since the Great Depression. This wasn't just a bank failure. This was the moment that proved too big to fail was a lie. And when Lehman died, it nearly took down every major financial institution on the planet, with it triggering a cascade of panic that would destroy 10 million American jobs, evaporate $16 trillion in household wealth, and leave scars on the global economy that we're still dealing with today. If you want to understand how one company's collapse can destroy the entire world economy, hit that subscribe button and drop a comment about what financial crisis we should cover next. Because the story of Lehman Brothers is the story of greed, leverage, and what happens when regulators decide to make an example out of someone at exactly the wrong moment. Lehman Brothers was founded in 1850. They had survived the Civil War, 2 World Wars, the Great Depression, every recession and crisis for 158 years, and by 2007, they were the 4th largest investment bank in the United States, with $40 billion in revenue and a stock price near $60 per share. But underneath that success was a ticking time bomb. Lehman had become addicted to mortgage-backed securities. They were packaging subprime mortgages into complex derivatives and selling them to investors around the world. And when the housing market started to crack in 2006, Lehman doubled down instead of pulling back. The CEO, Dick Fuld, was known as the gorilla of Wall Street, aggressive, ruthless, and absolutely convinced that real estate would always go up. He had led Lehman for 14 years and built a culture of extreme risk-taking and leverage. By 2007, Lehman's leverage ratio was 30-1, meaning for every dollar of capital they owned, they had borrowed $30 to make bets, mostly on real estate. This worked great when prices were rising, but it meant that even a small decline in asset values could wipe out the entire firm, and that's exactly what started happening in 2007. Bear Stearns collapsed in March 2008, and everyone on Wall Street knew Lehman was in even worse shape. But Fuld refused to admit it. He rejected offers to raise capital. He turned down potential buyers, and he kept insisting that Lehman was fine, that they just needed to ride out the storm. Behind the scenes, Lehman was using an accounting trick called Repo 105 to temporarily move $50 billion of toxic assets off their balance sheet at the end of each quarter, making their leverage look better than it actually was. This was fraud, but nobody stopped them because the regulators were asleep at the wheel. By September 2008, the market had lost all confidence in Lehman. Their stock was collapsing, clients were pulling money, and counterparties were refusing to trade with them. The death spiral that killed Bear Stearns was happening again, but this time there would be no rescue. Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke made a decision. They would not bail out Lehman Brothers. They wanted to send a message to Wall Street that moral hazard had limits, that not every firm would be saved, and they believed the system could handle one major failure without collapsing. They were catastrophically wrong. That weekend, September 13th and 14th, Lehman executives scrambled to find a buyer. Bank of America looked at the books and ran away. Barclays wanted to buy them, but the British government refused to guarantee the deal. And by Sunday night, it was over. There was no rescue, no merger, just bankruptcy, the largest in American history. On Monday morning, September 15th, Lehman Brothers was dead, and the panic began immediately. Here's what you need to understand about why Lehman's collapse was so devastating. Lehman wasn't just a bank. They were a critical node in the global financial system. They had $900 billion in derivatives contracts with thousands of counterparties. They were a primary dealer in U.S. Treasury securities, and they were deeply interconnected with every major financial institution on the planet. When Lehman filed for bankruptcy, all of those contracts went into limbo. Nobody knew who owed what to whom. Trust evaporated instantly, and the entire global credit market froze. Within hours, Reserve Primary Fund, a money market fund that held Lehman debt, broke the buck, meaning investors lost money in what was supposed to be the safest investment possible. This triggered a run on money market funds that threatened to destroy the commercial paper market. which is how major corporations fund their daily operations. The stock market went into free fall, the Dow Jones dropped 500 points in a single day, credit default swap spreads exploded, and banks stopped lending to each other because nobody knew who would fail next. AIG, the giant insurance company, was on the verge of collapse because they had sold credit default swaps on mortgage-backed securities and couldn't meet the collateral calls the Fed had to rescue them with $182 billion just to prevent another Lehman-style implosion. Washington Mutual failed 10 days later in the biggest bank failure in U.S. history. Wachovia nearly went under and had to be rescued by Wells Fargo. Morgan Stanley and Goldman Sachs were hours away from bankruptcy and had to be converted to bank holding companies just to survive. The contagion spread globally. Iceland's entire banking system collapsed. Ireland had to guarantee all bank deposits to prevent runs. European banks needed massive bailouts, and credit markets around the world were paralyzed. Congress was forced to pass the $700 billion TARP bailout just to keep the system from completely imploding. The Federal Reserve cut interest rates to zero and started quantitative easing, and governments worldwide injected trillions of dollars to prevent a second Great Depression. The human cost was staggering. 9 million Americans lost their jobs, 10 million lost their homes to foreclosure. $16 trillion in household wealth, evaporated retirement accounts were destroyed, and an entire generation's faith in the financial system was shattered. Dick Fuld was called before Congress and grilled about his role in the disaster. He claimed he was a victim, that nobody could have seen it coming, but internal emails showed he had ignored warnings and rejected rescue attempts right up until the end. If you found this valuable, make sure to subscribe and share this with anyone who wants to understand how greed and leverage can destroy the world economy, because Lehman Brothers proved that when you're too leveraged and too interconnected, your failure doesn't just hurt you, it hurts everyone. And that lesson is more important today than ever as we watch new bubbles form in private equity, commercial real estate, and zombie corporations kept alive by cheap money.